Let me start with you, Karl, in Cape Town. You are pro. Why?
We think it's pretty simple. We think that with passive investing, you know what you get. You're going to get the returns of the market. And we think the attraction of active investing is that there are a few managers, good managers, that consistently beat the market, and they beat the market by a big margin. So we've had a look at the 10-year returns of the managers in the South African market that we think are good managers, and investors were 50-60% up on the market over that 10-year period just by sticking with the good managers.
Roland, you are for the passive position. You just say leave it to the tracker index fund, let the market determine the position.
That's correct. There are two real reasons probably why people should consider having a significant portion of their money in passive tracker funds. The first is a cost argument. Because of costs, there's a drag on active fund managers' return on average. And then the other reason is that there's no real evidence to show that on average active managers outperform. In fact, 2/3 of active managers underperform the market over time.
Okay, let's come back to you, Karl. What happens when the fund manager picks the wrong stock? Because effectively, you're investing in companies versus the index. And what we've seen through the global financial crisis is that companies have underperformed. What happens in a situation like that where all of a sudden the margins are lower and you're not performing?
Yeah, the investment industry is no different to any other industry. You get good accountants, bad accountants, you get good lawyers, bad lawyers, and you get good fund managers and bad fund managers. So I'm not saying that if you go to any fund manager, you're guaranteed to do well. What I am saying is that if you do your homework and find the good managers, and we think it's pretty easy to find them, then we think that these managers have a track record of consistently beating the market and by a big margin.
Okay, Roland, what happens when the index underperforms? What we've seen also recently is that although the JSE now has improved significantly, is at a 12-month high, it suffered the repercussions of what happened in 2008.
Sure. I mean, bear markets, you are not protected from bear markets with an index fund. Absolutely. You are not protected from bear markets with fund managers either. There is no evidence to show that in bear markets, fund managers outperform the market in any way either. So basically, you're exposed to equity risk, whether you're with an index fund or with an active manager.
Is it better to rise and fall with the market?
Sorry, if I could interject there.
Yes.
Just to make the point that we think it's in tough down markets that the really quality managers differentiate themselves. And for example, our funds have had a fantastic year in the last 12 months. So I think that the protection to investors with good active managers is most strongly felt in these very trying times and volatile markets we've seen of the last year.
Okay, I'm glad you raised that point. I'll come back to you later. If you've got a good manager, Roland, he anticipates a few problems. He's busy tracking the various company stocks, and he says, withdraw, and he sells and he takes you somewhere else. You have to go with the index no matter where it's going, even as the situation exacerbates in a bear market. You don't have the option to withdraw.
Sure. You are assuming when you say that the fund manager has some kind of market timing ability or some kind of skill to identify that. I can just read you one sentence from probably the most comprehensive global survey in the world, and it says the belief that bear markets favor active management is a myth. 8 out of 9 style categories of fund managers were outperformed by the indices in 2008.
Quibi, is it better to rise and fall with the index passively, or to go with a fund manager who's managing your investment by tracking day by day the company performance?
Look, Loretta, I think it's a philosophical question, because all good investment managers start off with a philosophical base of actually understanding what it is that they're trying to achieve and how it is they're trying to achieve it. Now, it's no different between a tracker fund or somebody that's trying to track the market than it is about people trying to actively manage a portfolio. And that is really a question that I think that an investor asks and that needs to answer that question at the end of the day. You see, if you fundamentally believe that you can add value by picking good companies or good stocks, and you've got a methodology for doing so, and you're prepared to do so over time, there's evidence that you could make good money. There are people that make good money.
Right.
But then there are people that make as equally good money out of just tracking the market and not paying a higher fee for doing so. So the question is really to the investor at the end of the day. What are you as an investor, and how is it that you want to actually act?
What you're looking for as an investor is good performance, because at the end of the day, you are investing your pension, your life savings, for instance, and you're looking for good differential in terms of the median rates of return. In good times, we saw the rates of return being something like 7.8 to 7.5 in terms of a tracker index, and also looking at what fund managers were bringing you by investing in the JSE top 40. In the midst of the recent crisis, I know that it's peculiar and it's special circumstances. What were the median rates of return? Because that's what you need to identify.
Yeah, I think that, and I mean, Karl, you gotta maybe just come in here as well, because I don't know the Coronation numbers out of my head. But certainly, if you look at active managers in a downturn, if you protect your portfolio and you understand how to protect portfolios, you would have done better than what a tracker fund would have done. But that certainly is not necessarily the case over the long term, where you potentially have a situation, say for instance on the JSE All Share, where people battle to beat that index over long periods of time, and hence a subpar. And once you reduce and once you take the fees out of the equation, you're actually way below the index. And that's, again, it comes back to Karl's point that he made just now. Is it's a skill factor. You know, there's good fund managers, there's bad fund managers. I think that the case for, you know, if you look at the case for tracker funds, and this is the one thing that I think the caveat that you need to have as far as this debate is concerned is, you know, people look at returns and say, where do I want to be as far as returns are concerned? And that's the wrong question to be asking as far as investors are concerned. You should be asking a philosophical question before you ask a returns question. Back in 2008, which is June, July, 2008, we saw resources buying up and becoming more and more expensive as part of the overall basket of shares that you could buy on the JSE All Share. And obviously tracker funds looked fantastically good relative to active managers, which was shying away from buying more and more expensive resource companies.
Let's bring in Karl there. Average rates of return, how did you perform?
Well, we've just had a fantastic year, and I think, you know, just not to talk about our funds, but to talk in general, the last 18 months is a fantastic case study in the advantages of investing with a good active manager. We, middle of last year, we had a commodity bubble, and in a passive fund, you would be forced to be very fully invested in commodities when prices are very high. In our funds, we actually didn't own commodities. We were significantly underweight. And you know, it hurt for a while, but in time we were vindicated, and our clients did incredibly well from avoiding very overvalued assets, which a passive investor is forced to own at the top of a cycle.
You did really well as tracker funds with the bull run on commodities generally, we're told. When those prices started being a little volatile, what happened?
Well, the index will track the market, and if you're asking me where commodities are going, I can't answer that because I'm not an active manager. But you will find that the index will be exposed to those kind of stocks and will ride those in ups and in downs.
Okay, well, on an upward cycle, I think with gold at about 1,060, and people expect that to be going upwards. Platinum also improving somewhat. Oil's a little bit tricky, and many people are saying that's where tracker funds really perform well, is when they're buying into resources.
The trick with a tracker fund is understanding what you buy. That's the trick with a tracker fund. There's 17 different ETFs that are listed in the South African market. Could be slightly more now, I'm not exactly sure. But your big issue as far as tracker funds are concerned, what are you tracking, and are you happy with the constitution of the actual benchmark and the constitution of what you're busy tracking? It's pointless buying a tracker fund and saying, I want to track the South African market, but you don't understand the risks of the South African market. You have to understand what it is that you're buying and how you're going to be dealing, if there is concentration risk, how you're going to be dealing with that. Roland, what are some of the ways that one deals with those type of issues?
Well, the main reason that people use ETFs, and I can assure you that the largest users in the world are actually active investors. Institutional investors use more ETFs than anybody else. And the reason for that is a risk argument rather than a return argument. So if you want to control your risk, you can't yank your money from a fund manager with that is invested in on a long-term basis and incur high costs. So what you do is you use these ETFs to actually adjust your risk profile very liquidly and quickly in the market without having to affect what fund managers are doing. So they're actually, for portfolio construction reasons, very important building blocks.